Welcome everyone, it's Lex van Dam and James Helliwell from the Lex van Dam Trading Academy. We're here today to discuss an interview that was released by Real Vision recently with Willem Middelkoop, and he's a big fan of gold. The video is about an hour long, his interview with Real Vision, and we're trying to do a summary of this, highlighting the reasons why he thinks gold is going up, and we will give our feedback to see if we actually agree with this. So for those of you who don't know me, I've been trading for the last 20 plus years, started at Goldman's, and currently as a hedge fund manager. I'm also known because of my TV program that I did for the BBC called $1 Million Traders, and the last 5 years been running a trading academy as well. So this is the process that I normally use when I analyze a specific stock or currency or commodity, for example gold, and I want to apply this to the way Willem is looking at his case for gold. So I'll be looking at idea generation, how did he come up with the idea, look at the fundamental analysis, his technical analysis, going to look a bit at trading psychology and at risk management. So maybe you, James, want to talk about his idea generation.
Sure, thank you Lex, and hello everybody. In the video there's certainly a lot of information in there, and William goes into detail around each of the reasons here for potentially owning gold. First of all, in line with the idea of a so-called big reset occurring, a supposed collapse of the banking system as we know it, and an erosion of all of this debt which has been built up, there's a possible case for reintroducing gold back into the monetary system, and that could see gold simultaneously revalued to as high as $4,000 an ounce, according to Willem's projections. In addition to this,
and possibly even higher, right? 8,000 he was talking about as well.
Yeah.
So this will be a minimum where he sees it going to.
Yeah, and in terms of supply and demand factors, so demand from the jewelry trade, physical demand, there are also now some supply shortages which we'll look at. Okay. In addition to this, also paper claims, so something of a shortage at the exchange, to put it lightly, on COMEX. We'll look at the chart in a moment and we'll see the magnitude of that. And finally, one of the best quotes from the interview was the mining companies, so the guys that have access to the supply to pull more gold out of the ground, as it were, represent a once-in-a-lifetime opportunity, having been sold off so hard over the last few years.
I mean, my view on this is that, yes, there is too much debt in the world, and one day gold could make a comeback. However, the timing of this, I really have no idea. When he says mining companies represent a once-in-a-lifetime opportunity, might be true. A lot of these companies are down 80 or 90% from their previous highs. However, the question is if gold is going to go up soon enough for these companies to survive. So obviously the mines themselves will survive. The question is if the mining company that's currently owning the mine, if they don't have too much debt, and if they have too much debt and they can't pay it off before the gold price goes up, then you might still end up with a worthless share, and gold could go up a lot after that. So idea generation, okay, it's interesting. Gold will go up sometime. Yes, I agree. If the timing is right, I'm not convinced yet. So I need to do more analysis. One of the ways we do our fundamental analysis is look at use a report from SocGen. So we use that in our trading club meetings as well. And in here we look at a number of factors that are either bearish or bullish for gold. And you see here they're using 7 different factors, and overall they're not that convinced that the situation is that bullish for gold. In fact, it's a little bit bearish. One of the reasons that they don't like gold at the moment is because SocGen believes in a very strong dollar, and if the dollar goes up, gold doesn't tend to do so well. They also believe that gold price will be kept because the US economic outlook is doing quite well, which means that interest rates would go up in the US, which is also not very gold bullish. Then there's the geopolitical outlook. They don't believe in World War III. They think that everything is kind of calm around the world, and although it might not quite look at it when you read the news, there are no major wars between the major powers going on. So there's actually quite a few bearish factors for gold. The only thing that's bullish is China adding to its gold reserves, but we all know that China is currently not doing too well. So the question is, can they really buy a lot more gold? So if I look at my fundamental analysis, I'm not convinced that gold is that it's the right time to buy gold.
So looking to one of the highlights, which does bode well, is the significant shortage in terms of gold claims, which compare the open interest on futures contracts in gold to the amount of gold available in vaults for delivery. Now, the quote here at the top you can see, Willem's anticipating a potential default on the COMEX exchange and mentions I believe it was the late 1970s, there was a default in potato futures of all things, where trading ceased from that point on. And he's anticipating that there could be a similar sort of event here. What do you think, Lex? Have you seen this chart before?
Yeah, I've seen the chart before, and it's a very technical chart. And Willem might be right. Normally what happens is if an exchange is about to default, they change the rules and they kill the speculators. Personally, I would look at the gold ETF shares outstanding. That, to me, would say a lot about speculative demand for gold. And that is, it started to tick up a little bit, but it's still at the lower end of the range. So I don't think there is that much demand for gold at the moment. It might all come, it might all change quickly. But yeah, this chart itself, I don't understand well enough to be able to make a decision on. So then we're going on about the physical demand by India and China is quite significant, the same as worldwide production. And what I would say here is that it's really, with the gold price coming down, production is actually coming down as well. So there's less gold being produced at $1,100 than it was at $1,700. So production is definitely going down. So I would say that is that's a tailwind for gold. So that's bullish. And the question here obviously is: will India and China continue buying if there's a slowdown in the world? And I would think that, well, you know what, supply is going down. I could easily see demand go down as well. So not convinced either. And then here, this the theory that traders are selling futures on margin to keep prices down. It might well be true, but I don't know enough about it to be able to say, okay, now you must buy gold because futures are being sold by traders. So that to me wouldn't be enough of a reason either. Then selling gold producers now is the most stupid thing you could do. It goes back to my previous argument that if the gold price stays down long enough, then plenty of these gold producers will get into trouble, and you might see the gold price go up in a couple of years, but the company that you bought might no longer be around. So if you do this, then you need to have a gold company with a very low marginal cost of production and not much debt that they need to pay a high interest on. And then, yeah, so obviously when you buy a mining company, these are the kind of things that we look at for any company, and you need to do that for mining companies. The one thing I would say for mining companies as well is that management of these companies is in general pretty bad. They overinvest when the gold price is high, and they do all kind of acquisitions, and then when the gold price comes off, they don't really know what to do anymore. So I'm not that keen on mining management. So then we look at the technical analysis. Maybe you want to talk about this, James?
Yeah, sure. So this shows the relative performance of the so-called junior gold miners, including the likes of, I believe it's Lakeshore Gold, that Willem mentioned in the interview, compared to the spot price of the underlying metal. And we've seen on an enterprise value basis, the gold mining stocks do appear incredibly cheap, or as cheap as they have been relative to the reserves. And this chart somewhat demonstrates that. Whether or not this is the bottom, I think along the way on this ratio chart of the last 5 years, people have perhaps thought that it was beginning to gain a base and some stability, only to break lower. Perhaps it will head lower from here. Personally, I think it's beginning to form something of a base, but again, I wouldn't be alone if I were wrong at this point.
I think if you're right on the gold price and gold price goes up, then you have your leverage in buying junior gold miners.
It's basically like a call option, if you want to say it that way.
Yeah, it just goes quicker, but then if gold goes down, you lose all your money. So then psychology. There's obviously like a serious issue with gold and psychology. For a lot of people, it's not quite clear why they actually own gold. Do you own it some people own it as an insurance. Some other people own it based on speculation. So it's quite difficult to trade gold if you don't understand your own psychology. And we produced a course just purely about trading gold, and the psychology of gold is really important. So in the insurance, reason for insurance might be because you think it's going to be World War III. So you just say like, oh, yeah, I need to own gold because that's the only thing that's going to have any value. It might be a temporary hedge. So you might just say, okay, I don't believe in World War III, but over the next year, I think stuff is going to be quite hard. So that's why I want to buy gold. It might just purely be diversification. You don't know what's going to happen. It's an uncertain world. Let's own a bit of gold. And it might be because, you believe there's too much debt in the world and paper money will become worthless. There will be a big reset. So you want to have something that will maintain its value. So that might be. So those are all, to me, insurance reasons to own gold. And then there's the speculative reasons, which can be, you believe the fundamentals are really good. There's much more demand than supply. It can be the technicals are good. It's breaking, it's holding a level, and then now it's about to break out. And you can speculate in fear. It can be that other people own gold because they're worried. So you might trade based on that because you think, oh yeah, if there's a conflict there and people start buying gold, so let me buy gold ahead of them and then sell it later back to the people who want to buy it. So there's many reasons to buy gold, either insurance or speculation. And if you don't understand why you are actually buying gold, there's a good chance that you will lose money. So when people say it's a one in a lifetime buying opportunity, like Grant Williams is saying, that's happened 8 times in the last 3 years. I think it's probably happened about 100 times in the last 3 years, depending on who you speak to. So you need to be really, really aware of your own psychology, because gold can go from 1700 to 1100 and can go to 600. And what are you going to do then? So here, Willem is saying institutional investors are out of commodities, period. Yes, that's true. Futures positions much lower, ETF positions much lower. People have been selling as the market's gone down because people are looking for yield. And if you own gold, you're not going to earn anything. So if you start buying gold now, you're one of the few people who own it. So I would say that from a if you want to be anti the mass, then it's a good point to buy gold. That I do believe. It's out of favor. So then risk management, maybe James?
Sure. You mentioned for diversification or hedging purposes, you may own some gold in your portfolio, even if it's not necessarily a core position. As per William's suggestion in the video, 10, 20, possibly even a third, 30% of your portfolio in precious metals, according to Willem, wouldn't necessarily be a bad idea, and I generally would agree with that.
And I would agree with that.
Yeah, I think it's a good idea to have at least some exposure there. And as you can see here, in terms of current speculation and the outlook for asset classes, regardless of what you're trading over the next 12 months and beyond, it's all coming down to what's going on with the Fed. We're in a very soft patch when it comes to the economy at the moment, the US economy. That may, of course, change by the time this video is played back in the future. But the Fed has just begun to raise interest rates, having had basically a zero interest rate policy for best part of 7 years now. What you can see on the left is at the end of December, the market was pricing only a 10% probability of Janet Yellen and the Fed reaching her 1.375% guidance target by the end of 2016. And 1 month later, just less than 1 month later, the market is now priced, at the time of recording, less than 1% chance of that actually being achieved.
Yeah, so from a risk management perspective, the one thing that's really worrying is if US rates go up, because people then rather have the money in the bank and earn a few percent a year than buy gold. So it's gold negative. If you believe rates are going up, then be very worried about gold. However, I think what James demonstrated is that rates in the US are not going anywhere very soon, which will be bullish for gold.
Yeah, and the reason for this, so one of the reasons for this, is concern over the state of the economy. And if that's the case and risk assets sell off, your natural hedge is is gold, is to buy gold, the inverse of the S&P performance.
But these are good data to keep on looking at, to see how that changes over time, to see if you buy gold, if this probability of rate hikes is starting to go up, then maybe it's time to sell, because it's it's not going to happen. Obviously, it's not just about nominal interest rates, it's also about real interest rates, and those are one of the things that we discuss in the Trading Academy, both in the courses and in the trading club. So my conclusion on the interview is that Willem is clearly making a very interesting case for buying gold at this moment. From my perspective, I'm not convinced yet that this indeed is that moment to buy gold, for reasons we have gone through, including buying the gold miners at this point in time. But it's definitely very, very interesting, and it's worth keeping on your radar screen, because I do believe that at some point gold will go up a lot, just not sure from what level. And James, anything else you would like to add?
Sure, yeah, just like to thank everybody, of course, for the comments on the video. And for those of you who are interested in getting more of this information on a month-to-month basis, if you send us an email to info@lexvandam.com, we'll be glad to answer any of your questions. And if you are interested in Real Vision, you can click the link below for further details. So from myself and Lex, thank you for joining us, and good luck in the months ahead, and happy trading.